Come on in, sit back and relax. And I'm your host, Craig Iskowitz, founder of Ezra Group Consulting. This podcast features interviews, news, and analysis on the trends and best practices all around wealth management technology. And this being our May news roundup, we have got a lot of stories to cover. For some reason, we didn't do an April news roundup. So we've got double the stories, which is good for you. And I'm going to really squeeze them in and have a lot to say. We're talking about a number of things just real quickly. We're talking about LPL Acquiring Commonwealth, Schwab investing in wealth.com, Josh Brown investing in Finney, lots of investment news. RIA platform Flourish acquires Sora Financial. YCharge launches an AI chat for advisors. More AI news. Raymond James appoints first AI chief officer. Adipar raises $200 million. UBS closes their robo-advisor. And then, of course, the advisor tech map that I do with Michael Kitces and our WealthTech integration scores. A lot of our news this month is about acquisitions. And if you are a firm looking to make acquisitions or you think it might be acquired, you need to run, not walk to our website, ezragroup.com, and click on the golden Contact Us button on the homepage. The experienced team at Ezra Group can help you improve the capabilities of your tech stack, work through your operational issues, make your firm more scalable, which is going to work whether you're being acquired or you are acquiring. And if you are acquiring, we can help you with the integration processes, onboarding new firms, moving their data, and getting everything in order. So if you're a fast-growing RIA or a broker-dealer, you need to talk to the team of experts at Ezra Group. We can help you run software operations, workflows, or even business strategy. So Ezra Group just makes tech stack better. That's ezragroup.com. And a few housekeeping tasks. Please subscribe to the podcast wherever you listen to podcasts. Check out our sponsor, the Invest in Others Charitable Foundation at investinothers.org. And if you are a wealth tech vendor selling software into our space, you need to check your wealth tech integration score at ezragroup.com, and you should register your product there at ezragroup.com/registration or register. And you can then update the integration data we have in our database, and your wealth tech integration score will always be up to date. Now, let's kick this thing off. And our first story, it's the biggest story of the past couple of weeks, at least. LPL acquires Commonwealth, the last domino falls. Quick disclaimer before we get into this. Ezra Group has provided strategic consulting services to both LPL Financial and Commonwealth Financial Network at different points in time, including strategy and software implementation support. All right. So a quick overview. The independent broker-dealer world just lost one of its last big holdouts. LPL Financial is buying Commonwealth in a $2.7 billion deal. Now, if you followed this space for a while, you know this is a big one. Commonwealth has long been seen as the anti-acquisition firm, fiercely independent, advisor-focused, and private since day one. And that era is now over. Now let's rewind a bit around the context. Now, Commonwealth was founded way back in 1979 and built a loyal following of almost 3,000 advisors. Now, they weren't the biggest, but they were known for their elite service, very strong compliance, and top-tier technology. They were also a quiet trendsetter. Back in 2019, they spun out their internal tech platform, which is called Advisor 360, into a company called Advisor 360, which later became a very strong advisor-centric tech stack. Now, LPL, meanwhile, has been on an M&A tear. In the past 12 months alone, they added Atria Wealth for $800 million, brought in 5,000 advisors through Prudential, a partnership with Prudential, and now manage over $1.7 trillion in assets. Now, this new deal pushes them well past the $2 trillion mark. Now, of course, LPL and Commonwealth have long respected each other. They've also competed fiercely, especially on the service model and advisor experience fronts. And Commonwealth clears their assets through Fidelity's National Financial, and that's where things get a little bit messy. LPL is self-clearing, and it's pretty obvious that those $285 billion in assets are moving in-house to LPL's custodian by mid-2026. Now, while Fidelity's institutional custody business certainly doesn't want to lose these assets, it's not going to be a huge impact on their business since they have over $8 trillion in custody. Now, it could be a logistical headache for the thousands of advisors who have to repaper their customer accounts, but that's a different story. Now, the deal also comes with a cultural shift. Commonwealth prided itself on being boutique and advisor first. Now, LPL is promising to honor that culture. But let's be honest, it's hard to maintain a boutique vibe when you're operating a $2 trillion scale and onboarding thousands of new advisors every quarter. That doesn't mean it's going to be a bad experience for advisors at all. It's just going to be different. So here's what we know. LPL is acquiring 100% of Commonwealth's holding company for $2.7 billion. The deal is expected to close in the back half of this year. Wayne Bloom, Commonwealth CEO, will join LPL's management committee and co-lead a new Office of Advisory Advocacy. Founder Joe Deitch is staying on in an advisory role to the LPL board. Now, also important, LPL is drawing a very hard line when it comes to how advisors are allowed to affiliate. Commonwealth advisors won't be allowed to join OSJs or third-party RIAs. They'll have to join LPL directly. That's a break from how Commonwealth operates in the past, and it tightens LPL's control over the advisor relationship. Now, why does this matter? This isn't just another deal. It's the most significant acquisition since the LPL bought NPH back in 2017. I want to say it's the most significant IBD acquisition, but Commonwealth is no longer an IBD when they dropped the FINRA license and became just a very, very large RIA. Though we still think of them as an IBD because they've been called that for so long. But it also closes, deal also closes the book on something bigger. Commonwealth was the last major, I'll just say last major firm that hadn't sold out to a private equity or another company, and now they're part of a publicly traded giant. That means the old model of founder-led, culture-first firms with purpose-built tech and no outside capital is officially over. Now, Commonwealth held out longer than most, but in the end, scale won. Implication for advisors, since this is more than just a platform transition, advisors were losing their optionality. LPL's already said there's no joining OSJs or affiliate RIAs, which restricts how advisors can structure their practices. And I posted this on LinkedIn when the deal was first announced, and a couple of people in my comments called this a forced funnel, and they're really not wrong about that. So there's been people who see this as a great idea, and some people who see this as terrible. Obviously, there's always going to be both sides of this issue, and we've worked with both firms, and we like the tech that both firms have built. Right, Advisor 360 and the other platforms that Commonwealth built work great for them, and their advisors love them, and it's a core part of how they deliver service to clients. On the other side, LPL has ClientWorks, which they have spent a lot of money on and built out. And it's a very capable platform. Now, it has improved tremendously over time. Where it is now is light years away from where it was when it started. And I think a vast majority of advisors really enjoy having the ClientWorks platform and all the capabilities it delivers for their clients. So how that plays out remains to be seen. And in every acquisition that we've ever worked at, in every enterprise conversion, and we worked on some very, very large ones, including ones larger than the couple thousand advisors here, there's always a breakdown of the people who are being moved. So usually it breaks down to thirds. So when you're bringing in a new platform, whether you're bringing people over from somewhere else or you're just bringing in a new platform to an existing firm, the users tend to break down to thirds. A third of them love it, think it's a great idea, and they're fully on board. So that's always helpful. A third of them hate it, and they will never use it over their dead bodies. And a third are kind of in the middle. So we always recommend to our clients, you got to go for that middle third. You got to target the middle third, get them on board, make them true believers, turn them into big raving fans of the platform. Then you've got two thirds. So then you're in good shape. Then the one third who hate it, you can start working on them. It's going to be a much longer process to get them on board, and some of them won't. So in some cases, it makes sense that maybe it's not the right fit for them anymore, and they need to leave or move on to other greener pastures. But hopefully you can convince a majority of that last third that yes, this is a good idea. Here's why. It might take a little bit more explaining and a lot more communication and internal marketing, but it can be done. So we talked about cultural. So Commonwealth's entire brand was built around responsiveness and autonomy. So can LPL preserve that while folding everyone into their centralized model? That's the question a lot of advisors are asking. So while it's true this is a bit of a gut punch for Fidelity, Commonwealth's longstanding clearing relationship with NFS was a very visible institutional win. That's walking out the door. So LPL moves all those assets in-house, and they're capturing more of the revenue stack, which is a great one of the benefits that LPL brings is that they are vertically integrated, clearing, custody, tech, and advisory platform fees, plus a lot of other service offerings. Having been at the LPL conference when you walk through their main hall and just the wide range of LPL functions and services and offerings, capital, outsourcing. It's really a soup to nuts offering for advisors, and they really like it. So let's see. So the ripples go even further on this deal. So Commonwealth's existing tech stack, Advisor 360, will remain in place until at least June 2026 under contract. But after that, and technically it's unclear, but I think everyone knows where that's going. LPL wouldn't make this deal without assuming that they're going to move all the advisors onto ClientWorks. That's how you get scale. There's no way they're going to have the same scale and same cost efficiencies if they keep two platforms, no matter how good Advisor 360 is, and it's really good. It just doesn't matter when you're the acquiring firm, you move everyone onto your tech stack. And we've seen it. I mean, I've seen this for 30 years. I've seen firms buy other tech, other platforms that are way better than theirs, and they still throw it away. Part of it's politics, part of it's scale. You've got your internal systems. You're not going to get rid of that to bring in something new. So there was some other news before this. For example, when it comes to LPL, they did lose a couple deals. Wealth Enhancement Group, almost $100 billion RIA, left LPL citing strategic misalignment. You can determine what that means. What does strategic misalignment mean? Some people in my LinkedIn comments said they think that LPL is too controlling, and some firms don't want to play by those rules. Now, Wealth Enhancement Group was an OSJ, and they walked. Merit Financial left as well. Now, LPL is still expanding. It's not going to stop, and you can't be everything for everyone. They try to be, but there are going to be some firms that maybe don't fit, and they'll keep moving on. They want people. They want to get the right people on the bus. So this is really a line in the sand for a lot of larger firms. They're all competing in the top 10, like Cetera, Osaic, and others. They're all looking to keep growing and keep scaling, and they're all competing with LPL. So they have to decide who's left, who remains standing, and who their dance partners are going to be. So this deal kind of closes the chapter on part of where we were as an industry and where we go from here. We'll see how if white glove service still holds true and if built from scratch tech without institutional capital can survive. Schwab announces strategic investment in Wealth.com to support estate planning capabilities for investors. Charles Schwab just took a stake in Wealth.com, one of the most talked about estate planning platforms in wealth tech right now. Now, it is a strategic investment that puts estate planning front and center in the advisor experience and signals Schwab's intent to fill a gap that most firms may have been ignoring for a little too long. Let's be honest, estate planning has always been a bit of the neglected stepchild of advisor tech. Most advisors either punt it to a local attorney, try to cobble together something with PDFs and trust calculators from 2007. So Wealth.com saw that as a gap and ran straight into it. Now, they don't claim they're trying to replace the trust attorneys, but they're building software tools that make estate planning part of an advisor's day-to-day workflow. Now, we're talking guided document creation, AI-powered document reviews via their AI tool they call Esther, and a full family office suite for firms serving complex clients. Now, it's been a busy year for Wealth.com. Since in the last 12 months, they have raised a $30 million Series A funding round with big names like Google Ventures, Citi Ventures, and Neuberger Berman. They rolled out integrations with eMoney and announced a big partnership with Cetera, which is huge. They also hired Nitrogen's former head of corporate marketing, my good friend Dan Bolton. Congrats, Dan, to help build their brand. And Dan had said that Wealth.com is building something truly remarkable. And if it's coming from Dan, you know it is true. Now, they also launched a national roadshow and plans for their own advisor conference in early 2026. Now, according to co-founder Danny Lorfink, 93% of clients want estate planning guidance, but only 22% say they're getting it. That's a pretty glaring disconnect. Now, Schwab in the mix, they haven't disclosed how big the investment is. I'm guessing it's in the tens of millions. I mean, why not? But it is a strategic partnership and one that lets Schwab plug Wealth.com's tools into their advisor platform and offer it directly to investors. CEO Rafael Loureiro said the goal is to make estate planning accessible and proactive and not something clients think about when they're 80. but something they address early, across generations, and as part of real financial planning. Now, this isn't Schwab just writing a check, which they've done before, and they've had other partnerships before, other integrations before. This seems more like a validation that estate planning isn't just some dusty legal add-on, but it's going to be core to the financial planning experience, which I think is a good thing, with Schwab putting it front and center. It also shows that their playbook, rather than building everything themselves, they often partner and integrate with great software. For example, let's say, so last note this year. So recently they've just announced an integration at Schwab with Income Lab, which is also financial planning, but more retirement planning software. And this is a real-time API connectivity that enables advisors to seamlessly access client information from Schwab Advisor Center and quickly build updated retirement plans. Last year, Schwab made a big announcement that they were selecting Focal as their exclusive AI-powered meeting assistant for financial advisors. Again, I don't know if there was an investment there, but they are the preferred product in that space. You can learn more about Focal and about AI note takers in our report which is on wealthtechtoday.com called AI Note Takers and Assistants Buyer's Guide. In 2022, Schwab announced a significant integration with Salesforce FSC and enabling people to initiate digital onboarding from Salesforce into Schwab, including account opening and address changes. And Schwab also announced last year a deepening relationship with Advisor Engine, one of the leading and up-and-coming wealth management technology platforms. And this includes expanded account opening capabilities and integration with iRebal, facilitating efficient portfolio management. So if you are an RIA using Schwab, you're about to get some access to some slick estate planning tools baked into the experience that are client-facing and actually usable. No more sending your clients to generic online will templates. This also raises expectations. So once this is embedded in Schwab's advisor platform, firms won't be able to say, hey, just switch over to this other application that is somewhere else. We want something that's integrated, which is going to be a much better experience for both advisors and clients. Now, this news really boosts wealth.com in the space from an upstart to a major player. Schwab's backing gives them credibility and runway and hopefully some funding to move even faster. Now, this move could be Schwab playing catch up to Fidelity, which of course owns eMoney with their own estate planning tools, and Pershing, who made a strategic investment in Conquest Planning. Now, this also puts pressure on the other estate planning tech providers to make their own big deals with brand names that advisors trust. If you look at EzraGroup.com in our integration scoring, you will see Wealth.com's excellent integration score of 7.15, leading the pack. Then there's other tools like FP Alpha, Vanilla, Luminary, Encore Estate Plans, all good tools. You should check them out. We don't prefer one over the other. We don't take any revenue share or a referral fee. So any application you think is good, I think you should check them all out. You can learn more about their integration scores at EzraGroup.com. And overall, the big picture, estate planning, looks like it's moving from the sidelines to the starting lineup, and Schwab just made it official. Also, if you want to learn more about wealth.com, go to wealth.com, but you also check out my interview on a podcast with CEO Rafael Loureiro, which episode 286, which came out April 10th. And in more investment news, Josh Brown has invested in Finny, a female-led AI-powered prospecting and marketing platform. Let's talk about a deal that's been flying under the radar, but could end up shaping the next generation of advisor tech. Josh Brown, yes, that Josh Brown, CEO of Ritholtz Wealth and one of the most influential voices in wealth management, just placed a big bet by backing Finny, an AI-powered growth platform for advisors. And he's not just writing a check, he's joining the advisory board and helping steer the roadmap. So why now and why Finny? Organic growth in wealth management is basically stalled out. Most advisors are running harder just to stand still. And according to most research, I think Tiburon announced this, that most advisors and most wealth management firms are only growing at 3%. So that's a pretty low, near stagnant growth. And 97% of advisors believe AI can help them grow their book much faster. So the timing couldn't be better. Now, Finny was built specifically to fix this. It's a prospecting and marketing copilot that uses AI to score leads, automate outreach, and learn the advisor's voice so messages land more naturally. In other words, it's not ChatGPT duct taped onto Salesforce. It's designed from the ground up for the advisor's workflow. Now, Finney has a proprietary engine called the F-score engine that looks at money in motion signals, liquidity events, career shifts, business sales, and builds a ranked list of the best fit prospects. Then it automates messaging that sounds like you, not a robot. Boy, I hope that's true. I'm always asking ChatGPT, don't write like an AI, write like me. So hopefully Finney's got that built in. Edin Ovadia, Finney's co-founder, was recruited by a major advisory firm to solve their growth problem. But instead of taking the job, she built the product the entire industry needed. She teamed up with Victoria Toll, who led global expansion for Uber One, and Theo Jansen, an AI engineer. 2 months later, they were in Y Combinator, which is pretty prestigious. They don't let just any old people in. So they graduated from Y Combinator successfully, and they've already raised over $4 million in investments and landed other investments from Orion, from Orion's Arun Anur, and now Josh Brown. And that's not just money, it's validation from leaders who know what it takes to scale both tech and advisory businesses. Now, I moderated a panel with Eden at Futureproof Citywide in Miami this year, and let me tell you, she brought the house down. She also joined me on the WealthTech Today podcast to talk about the AI toolkit that advisors really want and what most vendors still don't get. So you can check that out in some earlier episodes. And what was also interesting was at the conference, she was talking about, of course, I asked her about the Josh Brown investment because it had just happened. And what she said was they have an online portal that allows prospects to sign up for demos. And she said it blew up as soon as the Josh Brown news came out, and demos now booked out over a month or maybe 2 months. So she was telling people in the audience, hey, if you want a demo, come see me afterwards. I'll try to give you one, but don't go to the website because you won't be able to get one for 2 or 3 months. And that's just the power of a name like Josh Brown. The money isn't as important as the marketing, because in this space, there's so many tools out there vying for advisors' attention. And I know we do this for a living. It's all that we do at Ezra Group is look at software, and it's hard for us to keep up. So I know our advisor clients are always complaining they're getting overwhelmed with inbound marketing leads from software vendors. So what's nice about Finney, it's not just a fancy email campaign tool. It's really context-aware automation. Instead of spray and pray marketing, Finney narrows the list of people you're likely to click with based on shared background, business milestones, geography, and even what schools they went to. So it keeps advisors focused on meaningful outreach, not just cold spam, which we all hate. Eden told a story on our panel at Futureproof that one advisor used Finney to target Wharton grads who owned their own businesses in LA. It took the advisor under an hour to set up the campaign, and the response rates were 8%, which is wild for a cold outbound campaign. Josh Brown has called Finney the next logical layer of AI for advisors, and he could be right. It's certainly not replacing advisors, it's just giving them leverage. And there aren't a lot of tools in this space. It's not certainly not overcrowded yet. There's 2, 4, 6, 8, 9. If you look at the Keatsis Ezra Group Advisor Tech Map, which you can find at keatsis.com, Finney is in the prospecting category with other tools like Catchlight, WealthFeed, WealthHawk, and Tiffin AG. And they all, some of them do similar things, but they're not all doing what Finney's doing. Finney's sort of a combination of Catchlight and WealthFeed together. And that WealthFeed looks for money in motion events, but doesn't really rank the prospects, whereas Catchlight does a great job ranking the prospects, but doesn't bring them in. So Finney appears to do both of those together, which is a nice boost. So this is where things get interesting. You've got a whole industry racing to add AI and automation, just about every aspect of the advisor's workflow. And honestly, it's some of it's just fluff, and some of it is just ChatGPT with a nice thin layer. But Finney seems to have a unique way of looking at things and some pretty useful functionality I think a lot of advisors can use. So this is more than a seed round. It's a statement. Josh Brown's name on the board, and is really pushing Finney's sales and Finney's recognition in the market. And this next wave of advisor tech won't just make you faster; it should make you smarter and increase how advisors are able to grow. Finney seems to have the right team, the right timing, and now the right backing to pull it off. So this is where things get interesting. Now you've got a whole industry racing to add AI and automation to just every part of the advisor workflow. It's a little overwhelming. And some of it is just repurposed ChatGPT or other LLMs. It's really not a value-added service. Where I think Finney is. Finney seems to natively understand the problem and how advisors want to grow without, advisors don't want to be marketers. They want the automation to be able to handle that without losing the human touch. So it seems like it's a really good tool. And Josh Brown jumping in certainly sends a positive signal to the industry that you need to take a look at it at least. The bottom line that this is more than a seed round, it's really a statement. And the next wave of advisor tech that things like Finney won't just make advisors faster, it should make them smarter and help them grow at an exponential rate. Finney seems to have the right team, the right timing, and now the right backing to pull it off. And you can learn more about them at finneyai.com. Next up, RIA platform Flourish acquires liability management platform Sora Finance. All right, let's talk about a move that didn't get the same headlines as the big LPL Commonwealth deal or even Schwab's investment in wealth.com. But it is a big signal about where advisor tech is going. Flourish just bought Sora Finance. Now, Flourish, already well known in the industry, they've been around since 2018 for their cash management platform, which is an FDIC insured, white labeled, great UX, real adoption among RIAs. But now they're aiming to be the first true deposits and lending platform for advisors. So with this acquisition, they're trying to make the advisor as a bank, not just a concept, but a core piece of the RIA value prop. Before I go on, a quick disclaimer, Ezra Group has done some strategic consulting work for Flourish, both with integration planning, and with their before they launched their annuities platform. We helped them with that. So just want to get that out there. So let's zoom out. RIAs have always had a blind spot, liabilities. It's something that's been my pet peeve that more advisors aren't holistic, looking at both. They're easy to look at assets, but not looking at liabilities at all. So when it looks like investments, savings, retirement, those things are easy and they're usually covered. But when a client buys a house or refinances a loan, that money leaves. You don't know where it's going. It's out the door, and the advisor loses visibility and can't provide any advice. So Sora was built to fix that. They're an AI-powered liability management platform that works with 750 advisors and helps optimize client debt. Think mortgages, HELOCs, credit cards, student loans, you name it. Think of it as Right Capital meets Credit Karma, but with real advisory workflows behind it. Now, Sora scores every liability using real-time lender data and flags refinance opportunities, rate drops, or better terms. It's client-specific, not generic. And it's not just alerts, it's baked into cash flow planning and even estate models. This is a thing I think would be great because I wish my advisor would do that. Having kids in college and houses and things, you've got all these different loans, credit cards, of course, and I would love to have some proactive advice from my advisor about different loans. Is there a possibility of refinancing something? Is there a better rate out there? I'd love to hear that personally. So Flourish is going to absorb all of that and integrate that into their cash management platform. According to CEO Max Lane, they'll operate Sora as a standalone brand until early next year, when everything gets merged into a single experience inside the Flourish platform. So why now? Why this combo? It's about one thing, owning the full financial picture. So Flourish has always been cash first. They've got over $6 billion in assets on their platform across more than 900 RIAs. And their strategy has been pretty stable. Get onto the advisor's desktop, build trust with easy cash management capabilities, and then expand into other bank-like services like annuities, which I mentioned earlier, that they're rolling out, and now lending. One of the things that Flourish has done really well is integrate with CRMs and makes it very easy for the advisor while they're in the CRM looking at the client to click a button and open up this cash management account and be able to basically deliver better returns for their clients, money that's just sitting around. Flourish Cash is the number one integrated application in the cash management category with an 8.25 score, which rates superior. And you can check out their score in every WealthTech integration score at ezgroup.com. Now, it's also smart market timing for Flourish because household debt in the US is now over $18 trillion. It's insane. And younger next-gen clients are way more focused on debt than boomers. This gives advisors a way to stay relevant with a generation that doesn't care about dividends. They want lower interest rates on their student loans, as well as higher interest rates on any cash they have. So here's the win for advisors: better client retention, stronger planning, and fewer vendors. A client about to buy a second home, instead of losing assets to a mortgage provider, the advisor can proactively recommend the best lending options and maybe even help fund the loan through Flourish Cash. I know that. I'm looking to buy a house now. I wish I got some advice from my advisor. And for larger RIAs like Focus and Carson Group, both of whom are already working with Flourish, it deepens their offering without adding complexity. It's not just tech, it's workflow enabling. CEO Lane said it best, this move turns the advisor into a financial wellness advocate, not just an asset manager. And I think that's the future. So I'm a big fan of this. This raises the bar across wealth tech. Again, we all know most platforms are still focused just on the asset side, portfolio analytics, performance reporting, tax loss harvesting. But I think bringing in loans and lending into the overall holistic experience is going to be a big win for advisors that are already Flourish clients or that want to look at Flourish. And also, I think it also puts pressure on incumbent full stack platforms like Orion and Envestnet. They should have some sort of lending options built into their financial planning tools and into their overall tech stack. So the bottom line, this isn't just Flourish buying a niche startup. It's a clear signal that the RIA platform wars are moving into new territory. I think whoever controls cash and credit could be big winners, and Flourish just took a major step toward making that a reality. You can learn more about them at flourish.com. Next up, YCharts launches AI chat to accelerate investment research and enhance client engagement. So if you aren't familiar with YCharts, it is an investment research and client communications tool used by thousands of advisors. It has clean visuals, customizable charts, stock and fund data, model portfolios, and performance tools. Basically everything you'd want in a sort of a Bloomberg light for RIAs. And of course, charting, and hence the name YCharts. They've carved out a very nice niche as a go-to platform for creating investment visuals and proposals that, as in their opinion, don't make your clients' eyes gaze over. Now, they have launched something called AI Chat, not really a unique name. However, it is a next-generation AI-powered tool designed to enhance research workflows, improve efficiency, and drive better client engagement. Now, YCharts was recently recognized as a top performer in this year's T3 Insight Information Software Survey under the Investment Data Analytics Tools section, and as well as economic analysis and stress testing tools. Now, AI Chat feature builds on the momentum they have, providing financial professionals with faster access to insights and streamlined workflows according to the company. Now, we've all heard the hype, AI powered this, next gen that, but this application seems different. Instead of making you learn a whole new interface or forcing you to click through many, many layers of menus, YCharts is now just letting you ask questions like a human and get charts, data, insights, and explanations that actually make sense. So you get a prompt in a search bar in the AI chat tool, and you can refine queries by selecting specific data sources, including YCharts data, SEC filings, financial news, or proprietary research from their enterprise partners. By consolidating multiple data sources into a single interface, AI chat helps professionals find answers faster and focus more on strategic decision making. So that's really what they're looking for here. So for example, you can ask questions like, what's the risk profile of a 60/40 iShares portfolio? And instead of getting a bunch of irrelevant junk, it gives you the actual portfolio breakdown, visual risk data, and ideas to improve it. And it explains it all in plain English, no quant babble. Perfect for prepping client reports or answering follow-up questions with something visual and intelligent that doesn't take 45 minutes to build manually. Now, this isn't the first new feature YCharts has released. In fact, last year they put out a bunch of new features and functionality, including household portfolios and folders, which enables and allows users to make model transitions across multiple accounts, analyze the tax impact, and keep all the tools organized by client. YCharts also added risk profiles that allow advisors to unpack where the risk in a portfolio is coming from, and not just a number, but a real sector and factor breakdown. And YCharts also deepened their integration with LPL's ClientWorks platform, bringing everything straight into advisors' daily workflows. Let's not forget, PE firm LLR Partners bought a stake in YCharts back in 2020, and that gave them the capital to scale from a charting tool to something that can support entire enterprise RIAs. So we're now seeing the result of the funding, such as more automation, better integrations, and now AI that's actually useful. And speaking of integrations, YCharts scores an excellent 6.05 on the Ezra Group WealthTech Integration Score scale. which you can find at sgroup.com under integration scores, and you look in the category investment data analytics. So what we think this new AI tool will unlock for advisors is A, faster prep time for client meetings, B, better visuals for on-the-fly generation for impromptu client questions, and more confidence because it's grounded in real-time data. You can track the logic. So this could light a fire under the rest of the portfolio research and investment data analytics world. We're already seeing some AI tools come out, but this might push for more now that AI is getting ahead of it, and their competitors may be offering similar tools like FactSet, Quanti, Morningstar Advisor Workstation, FI360, and so on. AI really isn't a gimmick anymore. It's adding legitimate upgrades for investment research and client engagement. It's speeding up what used to be grunt work and helping advisors generate sharper, more accurate client reports and research. Now, it's not going to replace advisors, but it's going to make everything they do faster, clearer, and more confident in every conversation. And that's kind of AI advisors can actually get behind. To learn more about AI chat, you can go to ycharts.com or you can email them at hello@ycharts.com. Hey, next up, Raymond James appoints its first chief AI officer. So Raymond James has created a new executive position, Chief Artificial Intelligence Officer, and appointed industry veteran Stuart Feld to the role. This move formalizes the firm's long-running AI initiatives and reflects a growing trend across financial services to centralize AI oversight at the leadership level. So, a quick company overview. Raymond James operates a dedicated custody platform called RIA and Custody Services, or RCS, designed for independent RIAs. And it's part of the firm's broader effort to support RIAs who want flexibility and independence, but still value strong operational support, integrated technology, and access to institutional resources. Raymond James works with an estimated 300 RIA firms through RCS. And if we assume an average AUM of around 250 million per firm, that puts their total assets on custody at roughly 75 billion. Of course, they don't break that out. They do say that overall they've got 1.5 trillion in total customer assets across all business lines, but I believe around 80% of that is on their captive business, the W-2 advisors. Now, unlike some custodians focused purely on scale, Raymond James has positioned RCS around high-touch service and deeper integration into advisor workflows. It's also part of the corresponding clearing business, which a lot of people don't know they even have, which supports a range of broker-dealers and advisory firms with custody, clearing, and back-office infrastructure. All right. Ray J has been steadily integrating AI into various parts of their business over the past several years. They launched an innovation division called Carillon Labs in 2019, and they've been focusing on how to improve technology around practical business applications, especially with AI. This includes machine learning to reduce false positives in electronic communication review, supporting cybersecurity monitoring, and building predictive models to improve operational efficiency. According to CIO Vin Campagnoli, new tech are tested in limited pilots before broader rollout. Now, this applies to AI as well, so it avoids major disruptions while still advancing their internal capabilities. Ray J currently invests almost $1 billion annually in technology. That includes infrastructure like AI-enabled observability, which helps identify the root causes of system issues and supports automated remediation. On the advisor side, they're launching tools like Zoom AI with proprietary natural language search systems that have already been deployed to improve internal workflows and reduce time spent on manual tasks. You can check out speaking of Zoom AI, check out our AI note takers and assistants buyer's guide on wealthtechtoday.com. We cover Zoom as the top market share for the generic AI note takers in the market. So as I mentioned, Stuart Feld has been promoted to Chief AI Officer, making Ray J one of the few wealth management firms to establish this role. Now, Feld has held prior senior tech roles at UBS, JP Morgan, and Prudential, and has been leading AI projects at Raymond James for several years, but not with this title. So in this new position, he'll oversee the firm's AI strategy with an emphasis on service delivery, workflow automation, and data-driven personalization. So this appointment signals that Raymond James views AI as a strategic function requiring dedicated leadership, which we agree with. Rather than relying entirely on third-party solutions, the firm is investing in internal development and aligning AI with core service and productivity goals. In an industry where many firms are still in early experimentation phases, this reflects a more mature and structured approach. So for advisors, this move suggests continued investment in tools designed to reduce administrative burdens and improve response times. The AI search tool is just one example. It's designed to return specific contextual answers without the need for lengthy searches or support calls. Now, I'm not a big fan of this necessarily. Everyone seems to be launching these chatbot AI tools. What it really requires is that advisors become prompt engineers. You have to know exactly how to ask the right questions. But I think slowly these tools will get better and not require a specific prompt to get the right answers. And maybe they'll put more of an interface on top of it to make it easier to get to the most commonly asked questions. So we may be looking at other firms also launching chief AI officers. We have seen other firms launch something similar. I don't think they're called exactly the same thing, like TIA and AllianceBernstein have also had similar roles. So this new role reflects where Raymond James is going in the technology maturity curve, moving from tactical adoption to long-term integration and governance. You can learn more about Raymond James at raymondjames.com. All right, all right. Next up, Adipar, valued at 3.25 billion in the Series G funding round. Adipar, technology platform providers, RIAs, and wealth managers, has raised $230 million in a Series G, that's right, Series G funding round, which valued the company at 3.25 billion. The round was led by London-headquartered Vitruvian Partners and New York-based Westcap, a returning investor. Other participants in this round include 8VC, Valor Equity Partners, and EDBI, operating under SG Growth Capital, and investment platform of the Singapore Economic Development Board and Enterprise Singapore. Adipar now has more than $7 trillion in client assets on its platform, up from $5 trillion just a year ago, which is insane. The company serves more than 1,200 firms, including single-family offices, RIAs, large banks, institutional asset owners, and alternative fund managers across more than 50 companies. The primary use of this funding round was to give shareholders some liquidity via a tender offer, said Adipar CEO Eric Porter. The company grants equity options to every employee upon joining. It has more than 1,000 employees. Now, founded in 2009, Adipar focuses on performance reporting, data aggregation, and portfolio analytics for high net worth clients, family offices, RIAs, banks, blah, blah, institutions. The platform supports you. I said that already. So what's interesting about this is now that they hit 7 trillion, it's at how fast they got there in just a year from 5. And when you compare it to other major platforms in the space, they're the leader, right? Orion's got around 5 trillion, just under. Investments at 6 trillion. Now that's, of course, all these numbers are assets on platform or assets under administration, not AUM. Investments AUM is around 530 billion versus the last numbers I saw. And then InvestCloud has 6 trillion. So Adipar is the leader in terms of assets on the platform, which is not surprising considering they focus on the high net worth and ultra high net worth space of family offices, where each one of their clients could have tens of billions or hundreds of billions in assets, which is way higher median assets per B2B client versus an Orion. It's just not even close. So not surprising they hit that number. But what's interesting about the valuation with Adipar, which kind of flies under the radar, we don't really hear about them as much as the other firms I just mentioned, with a valuation of 3.25 billion. Last November, right before Envestnet was the deal with Bain was announced, they were taking them private. Envestnet's market cap was 3.5 billion. So Adipar is right up there. Now, of course, that's different. A public valuation is different than private, but it is pretty interesting. Now, on the Adipar side, 40% of their assets tracked are in alternatives. Some recent product rollouts include advanced alternative management tools, AI document extraction, which everyone is doing. It's so common. Private fund benchmarks, cash flow forecasting. Speaking of AI document extraction, I was just moderating a panel at Trade PMR's conference down in Tampa and talking to iCapital, and their doing a lot of AI document extraction for their alts business. There's a huge use case for AI. Adipar also launched a native trading and rebalancing platform, which is based on their acquisition of vendor Advisor Peak back in 2021. And they built a navigator forecasting engine from their acquisition of a company called RCI. According to the CEO, they invest over $100 million annually in R&D, and they integrate with 100 plus tech and data partners. You can check out their integration score, which is excellent in the excellent rating of 6.5 under the portfolio management category, which is crammed with 43 applications. Still quite busy there and more coming all the time. Back to their equity raise. Their total raise on this is a G round, so this is the eighth round they have raised so far since their founding in 2009. They're a total of $761 million raised. Just nuts. All right, so why does this matter? It validates Adipar's position as system of record and an analytics layer across wealth management tech stacks. And they're really trying to break out of the, hey, we're just for alts mode and be able to sell more to just high net worth advisory firms and wealth management firms and start taking market share from some of their competitors. It illustrates investor appetite for infrastructure-focused fintechs that underpin multi-trillion-dollar workflows rather than targeting retail or direct-to-consumer models. Why it matters, continued focus on AI-powered data normalization, recon, and predictive analytics, which sets a high bar for incumbents and startups alike. So advisors who are using Adipar can expect hopefully accelerated improvements in workflow efficiency, particularly in handling alts, document processing, and performance reporting. Their open architecture and integration-first strategy supports flexibility in advisor tech stacks rather than forcing rip and replace transitions. This funding and valuation reinforces the bifurcation between generalist wealth tech platforms and deeply specialized infrastructure players. I expect with this additional capital, not all of it's going to be sent out to investors or to employees. They're going to use some for more R&D. It should be able to build out more competition and more feature functionality for their emerging alts platforms. And the acquisition of a company called Arcus indicates a shift toward embedded intelligence across advisor workflows, not just dashboard improvements. So, in summary, Adipar isn't positioning itself as just a point solution. They're building a data and intelligence layer for the entire wealth ecosystem. You can find out more about them at Adipar. It's 2Ds, ADDEPAR.com. Next up, UBS to close their robo-advisor, joining big banks' retreat from digital advice. UBS plans to wind down their purely digital robo-advisor called UBS Advice next month, making it the test with the latest big bank to throw in the towel on digital advice. The company closed the robo to new accounts on March 21st, according to their Form ADV. UBS Advice had a $10,000 minimum and charged an annual advisory fee of 75 basis points on assets invested. Now, the robo strategy has shifted over the years. In 2022, under then CEO Ralph Hamers, the Swiss bank said it would buy U.S. robo-advisor Wealthfront in an all-cash transaction valued at $1.4 billion. However, shortly afterwards, both companies agreed to scrap the deal. Now, UBS's robo-advisor was announced with great fanfare back in 2018 as a partnership with tech vendor Sigfig. It was include features that now seem to be standard with digital wealth platforms, including account aggregation, portfolio diagnostics, and goals tracking, in addition to some versions of automated investment advice. But it is all under the bridge now. A lot of firms seem to be closing their robos. JP Morgan closed their purely digital robo-advisor called JP Morgan Automated Investing last year. Goldman Sachs closed Marcus Invest, its automated investing service, and sold Marcus Invest's digital investing accounts to Betterment. Earlier this year, Betterment said it was buying the automated investing accounts and assets of Ellevest, a wealth management robo founded by Wall Street veteran Sally Krawcheck. The industry seems to have shifted toward emphasizing hybrid robo advice, which is basically human advice with the digital front end, so the hybrid. It is proven popular with clients, at least when judged by assets under management. For example, Vanguard's personal advisor, which is their hybrid option, had 344 billion in assets as of December 31st, with just 21 billion for the pure digital robo-advisor. Now, this isn't to say that everyone is giving up on digital advice. Brokerage firm Robinhood has their version called Robinhood Markets, and they are offering this active management digital robo-advisor for just 25 basis points, which is capped at $250 annually in fees for Robinhood Gold subscribers. And of course, Robinhood has also acquired RIA Custodian Trade PMR, and I'm sure they're looking for some way to funnel maybe smaller RIA clients onto their digital platform as well. The overall global robo-advisor market is currently estimated at about 1.8 trillion in AUM, which I think is, I'm calling BS on that number. I can't imagine that's even possible. Vanguard is the largest with their personal advisor hybrid with 344 billion, and that can't be very much more after that. I would say at the most, the market is 750 billion maybe, but those are just what the stats are telling us. So overall, we're seeing most of these larger banks shutting down their pure robos. Everyone thought it was a great idea to get smaller accounts and grab all that business and be able to at least monetize it somehow, but it just didn't work. And of course, this is good news for advisors if they're looking at small accounts. That threat has kind of gone away from at least these larger firms. But there's still the problem of smaller accounts. It's still out there. We're still looking for ways to service these clients, and someone's going to come up with a good idea and make it work. I really think that there's going to be an AI advisor at some point that's going to provide what feels like human advice, but still be digital and scalable. And that's really, I think, going to cause a lot of consternation and be able to grab at least some kind of assets from this business. Here we go. My favorite part of the news. It's the Advisor Tech Map and the WealthTech integration scores. As you know, Michael Keatsis and I partner on the Advisor Tech Map, which is available at keatsis.com for download. And it's where we keep track of every application that is on our radar for independent advisors. And every month we add a bunch of new applications. Sometimes you don't add them if they aren't really software or if they are services or other types of things that just want to be on the map but really shouldn't, we don't add them. But if they are truly software targeting independent advisors, then we add them to the map. And we haven't done the news in a bit. I think we skipped one or two. So I'm going to go back to April and just run through April and May additions to the map very quickly. We have 15 applications that were added in the last 2 months to the map. So really quickly, Invent, data warehousing and analytics. And these, of course, Invent targets enterprise firms, very large RIAs, not just independent advisors. Odin Ultra, which is in investment research. We really like their self-writing demo on their website. If you want to go check out Odin Ultra's website, which I should have here. This is April, right? April. Odin Ultra is odinultra.ai is their website. Financial AI, your AI partner in asset management. So they're in the map. Covet Life, estate planning and asset management tool, which is categorized as legacy. So specialized planning legacy. We seem to think that their Covet Life is trying to position this as a way to attract next-gen clients, but could be a poor strategy. Not really sure not really sure young people can figure out who to pick as an advisor by more than the app that catalogs, your father's watch collection or something like that. So Covet is in specialized planning legacy, and their website is covet.life, COVE.life, if you want to check them out. Grain is under client meeting, and they're an AI note taker, but they're more generic. They're not really targeting advisors per se, but there is a fair amount of adoption of it by advisors. I think 4 to 5% market share. You can check that out in our AI note takers and assistants buyer's guide on wealthtechtoday.com. We do cover grain. And I think it's grain. What's the website? Grain. Oh man, April. Don't I have that? I apologize. I don't have the list here. So you can check out Grain. Just do a quick search for Grain AI note taker. The another website, another app is here is Havoc Defense, HOVC, havocdefense.com, and they are a managed service provider. They're not strictly a technology product, but managed IT services is on the map. So we put them in that category, even though technically they're services. And that's havocdefense.com. Then the last one for April was Finliti, FINLITI.com, which is behavioral finance, which and financial literacy platform, which we categorize as behavioral assessments. We really like the use of personalized content and messaging based on behavioral finance analytics at finliti.com. Okay, so that's the six we added in April. And then in May, in alphabetical order, Alles Technology, ALLES, technology.com under managed IT. Catalyst Pro is a portfolio management tool that handles complex financial planning and investment scenarios for high net worth clients. The website is Catalyst Writing, CATALYST writing.com, the catalyst for your strategic goals. The thought leadership platform built for wealth management community. Interesting idea. I'm not sure it's going to work, but it's definitely an interesting idea. Access a library that gives you a consistent cadence of insight posts for investment, financial planning, and business owner-centric conversations. Why not? I'm always interested in different ideas. That's Catalyst Pro. Continuum, another AI-powered note-taking and meeting summary tool. CONTINUUM. Oh, wait, I'm sorry. That's how you spell Continuum, but their website is on Continuum. Well, it's harder. ONCONTINUUM.com. We really don't need another AI note taker for advisors, but here we are. And they weren't included in our AI note takers report because they weren't around when we did the report last month. High Peak is healthcare planning, a platform that provides longevity insights and helps advisors with health and wealth planning. I like this idea. There isn't enough more holistic intelligence for advisors to do more than just assets. HighPeak.ai is their website. And they're categorized under healthcare and Medicare on the map. Next up is Improve. Whoa, another AI assistant, but it's spelled improve with a U, IMPRUVE, just to make it more difficult to find it. Right, so that's AI native operating system for growth-minded RIAs. Next up is PagePort Digital Marketing. The website is PagePort, just like it's spelled. Helps advisors build marketing funnels and automates client outreach and engagement through features like email, text, and video messaging. So it's a lot like what Finny is doing. Next is PlanPort, PagePort, PlanPort, this port, that port. PlanPort is 401k proposal generation. Software that helps advisors with retirement plan proposals, vendor RFPs, and participant distribution wellness advice. PPRetirement.com is PlanPort's website, and they're in the 401k proposals category. Sherpas, SHERPAS, Sherpas Wealth is in the sales enablement category. The first AI growth platform for financial advisors. More AI, automate financial data extraction, diagnostics, and investment planning so you can scale smarter, not harder. So this is we have them in sales enablement, but data extraction, financial health, investment analytics. Looks like they're sort of a Virgil clone, Sherpas Wealth. And then two more. One is Spaces CRM, a new CRM. We don't see them very often. Of course, they had to stick AI on it. AI native CRM for financial advisors. It is spacesos.com is their website. If you're looking for a new CRM, which I can't imagine most firms are. And finally, the last company is Testimony IQ, which is client feedback, provides client feedback and engagement capabilities, including new survey functionality. And that's a quick rundown of the 15 new applications we added to the map that you should see on the May map. June map is coming out soon. There's a total of 556 applications on the Keatsis Ezra Group map. Of course, if you go to our website, ezragroup.com, we have more applications we're tracking in our WealthTech Integration Score database because we are a superset, including enterprise applications. So we have 626 applications we're currently tracking with a median integration score of 4.44 and 2,882 total integrations analyzed by our crack integration team. And if you are a vendor of software for wealth tech or financial advisors, you should be on our website. You should check out your score for your application and register your application so you can update your data on our database. And we will always have the latest information, and your score will always be up to date. That'll be Ezra Group /register for anyone who's looking to update your data. And if you are a vendor with an application that has a good score, so if your score is 6.0 or higher, then you are eligible for our Ezra Group WealthTech Integration Score Recognition Program, which gives you a number of benefits. One is a badge you can put on your website that verifies you have been validated by Ezra Group as having a great score. That badge will also appear on our website when people go and look up your application. And there's a number of other benefits like access to our integration team, access to our research on integrations, and some other benefits like discounts on consulting. So you can find more information at ezragroup.com. And that's kind of a wrap for this month's news. Boy, that was a long one. Hope you hung in there for the entire episode. I really appreciate it. Before you go, please go to our website, ezragroup.com, scroll to the bottom of the homepage, and sign up for our newsletter. Once a month, you will receive an email chock full of wealth management goodness, news, information, and updates. You will not be disappointed. Thanks again for listening, and talk to you all again next time.